The current value of the stock is pricing in 76 years of NVIDIA's earnings. It is unreal. Now, intuitively, we know the incumbent politician wants the market to be doing well. They want to go into election season with everything firing on all cylinders so they can win.
The market, my guess is these stocks that have been on a tear are likely going to at least pause, if not give back some of their ground.
Hi, Tower Talk listeners. As you can see, we've got a great episode planned for you, and we'll get back to it in just a minute. Now, if you're not currently a Tower client, but you have questions about your investment portfolio, or maybe feel like you're not receiving the best service at your current firm, please reach out for an information-only, no-pressure discussion. We would love to hear from you. The email address is in the episode description. Now, if you are a Tower client and you have questions, we'd love to hear from you as well. I think you know how to get a hold of me, but if not, that email address in the episode description will work as well. All right, let's get to today's show.
Well, welcome back to another Tower Talk. We'll try and use your time well here. We've got a couple of general market type topics and then one that comes close to applying to our own strategy. So our agenda looks like this. We're going to talk a little bit about private equity. Number 2, election year results. And then number 3, we're going to talk about concentration in the US markets and how it relates to our fundamental indexing. Okay, here we go. Private equity. A couple months ago, we made the comment that it looks like there will be an illiquidity crisis or a liquidity crisis in private equity. What have you seen lately, Tarek, on that topic?
It's funny. We were just getting ready to record this, and Wall Street Journal just released an article describing some of the challenges a lot of large pension funds, endowments are having with their private equity portfolios. Some of the challenges are there just haven't been as many exits. And so private equity is in its nature illiquid. Your cash is tied up, and generally speaking, you get your cash out when they can sell the portfolio companies, but they haven't been able to do that because of high interest rates and whatever it is. Additionally, I think there is a concern that some of the valuations are a little bit higher. You don't have valuations that are being done by, at arm's length market participants. It's internally valued or, closely valued. And so there's some concern that the valuations aren't there. And some of these pension funds are having to get big loans out to try and make sure they can pay their obligations to their pensioners, or take a substantial discount on the value of their private equity holdings to get some liquidity, right? So to sell it for maybe 85% of the value.
Yeah. You remember this is what we made, the case we made a couple of months ago was we were beginning to hear about some overvaluations in funds. This came out very, very briefly with a Harvard article. So the Harvard pension or the Harvard endowment was having some trouble with liquidity. They needed to borrow $2 billion because they couldn't liquidate some of their investments. And immediately I was like, wait a minute. They have been overstating their returns for decades. No, for years, more than a decade. Number 2, this is not just Harvard that has been doing this, but all of the major funds. And it's internal managers who hire private, non-arm's length valuation, and then they end up overstating their returns. When this compounds into something that's a decade long or longer, yeah, the haircut that's coming, I think, is still coming. Anyway, that's it. Looks like our call on private equity is going to be the right one. It's always nice to note the ones that are right because we have a few that have been wrong. Okay, election year. What happens in election? Yeah, what happens in election years with the markets? Now, U.S. election this year, so
that's right.
The collateral value or effect on Canada will be there. So, what are the thoughts here, Tarek?
Well, and we're specifically talking about the U.S. election because the U.S. is the biggest market in the world. And generally speaking, U.S. elections are good for the market. Now, intuitively, we know the incumbent politician wants the market to be doing well. They want to go into election season with everything firing on all cylinders so they can win. And generally speaking, that's the case. So I have a chart here that I can put in the show notes that's from Morgan Stanley. It shows that during election years from 1928 to 2016, markets are up 11.3% in the States, right? So generally speaking, it doesn't matter if it's Republican, Democrat, when there's a U.S. election, markets do well.
Right.
And we've seen that this year, that's for sure, so far.
Yep. So far, the good year is in the bag. We'll hope it holds out. Okay. Talk about this concentration. We're changing subjects again. So now we're on title number 3. Concentration in US equities, Tarek, that you've been watching actually for quite a while. I think you've been talking about it for a year or longer.
It's true. I mean, and it's quite interesting, and it's kind of related to the election year thing because of it's based on the U.S. market. So currently, the US market actually represents 60, I think it's 62, 63% of the world's investable universe, according to the FTSE All World Index, right? And so it's substantial. Just to show you how substantial it is, the next largest country is Japan at 6.1%, right? So 60 to the United States, 6.1 is the next largest. Canada's at like 2.2, 2.3 or something like that. Now, in addition to that concentration, just in the U.S. market, which has been on a tear this year, the S&P 500, where the primary returns are, where the biggest companies are, has significant concentration of its own. So the top six names in the S&P 500 are names we've all heard of: Microsoft, Apple, Nvidia, Alphabet or Google, Amazon, and Meta, which is Facebook and Instagram. Those six names hold 31.5% of the market. So what we're
Of
seeing
the of
is
the US
of the
market.
US, yeah, S&P 500. So we've got 62%, 63% of the world in the US, and then 32%, let's say, in just six names, with a third of the returns in the S&P 500 year to date being just because of Nvidia, one stock so far. So the concentration is significant. Now, it's interesting because right now, everybody's, we're kind of talking about it. It's something that's interesting, but markets are going up. So it's not a huge concern, right? And so when things are going up and to the right, people aren't as worried about it. But, we're your portfolio managers and we're looking at this concentration and we're kind of like, whoa, this is, you know, a good portfolio management theory says we need some diversification here. This is not good. In fact, I was on a call last week, a talk from the chief investment officer from CPP, and he was discussing some of his concerns around that concentration and how they manage the CPP. And they're like, we just can't in good conscience put all of our, to try and match the world's equity markets, right? Especially because, as you've seen, Apple, Microsoft, Nvidia, these are all very related companies. They're all in sort of overlapping or similar
Yep,
sectors,
yep,
right? So
yep,
we're not
yep.
even seeing
There's
diversification in that way.
there's not even multiple name risk. There's single name risk in those six names.
Exactly.
Because
Exactly.
now you said the seventh one is Berkshire Hathaway.
That's right. Yeah, which is kind of a conglomerate. Yep,
Yep. So that's a more of a value type story.
it is.
Interesting. Okay. I remember a time when we as analysts were talking about Walmart, and it had a trajectory that looked like that. And we were joking among ourselves about when Walmart would become larger than the US and would end up taking over the world. And of course, that didn't happen. Now, what we were saying as
Mhm.
analysts was, hmm, maybe we should be diversifying away from Walmart. Now, Walmart is still a great company, and it still should be in major portfolios all over the world. So this is not a knock on Walmart. It's just the trajectory is unsustainable, and that is the point that we would make here. Okay, talk about those six names or seven names, whatever you want to choose there, in a fundamental index of the US.
Good question. So, as many of you who listen to this podcast regularly would know, at Tower, we use a fundamental index. So it's a different weighting than the S&P 500 would be. So for comparison, I looked at what those top six names are in terms of their weight in the fundamental index, right? So that's Apple, Microsoft, Amazon, Google, Meta, and Nvidia. And they're 31.5% in the S&P 500. They are just 8.35% in the index we use to represent the US market in our
So,
portfolios.
so what that means is those companies are creating fundamental value of 8% of the S&P 500, not 32% of the S&P 500 as they are in market cap value. What are the multiples like, PEs? I think you said
That's
this yesterday.
that's exactly what I was going to bring up next, actually. I quickly looked at Nvidia. Right now, Nvidia's price to earning multiple, it was June 17th. It was 76 times earnings for the price multiple, which
What does that mean? Tell me, unpack that.
it means the current value of the stock is pricing in 76 years of NVIDIA's earnings. It is unreal, absolutely the highest. I guess if you don't have a frame of reference to know whether or not that's high, it is outrageously high to price in 76, nearly 77 years of a company's earnings in today's price. That's not to say that NVIDIA is not making a lot of money, but that is concerning. That is very, very high.
Therefore, here's our confession. Our fundamental index has underperformed the US market
Yes.
over the last, I think, 2 years, actually. Um, I was looking at the numbers last night, just preparing for this call. And I think it was that for the last 2 years, we have underperformed in the fundamental index. That's because these momentum stocks have been on a run. I think it's getting time for the momentum to reassert itself. I think there will be a rotation in the market. My guess is these stocks that have been on a tear are likely going to at least pause, if not give back some of their ground. So if you own private equity, we would still say head for the doors. Get out if you can. Number two, if you own these stocks that have been such a great success in your portfolio, please consider taking off at least the money that you put into it. For
Yeah,
example,
take your wins.
NVIDIA 130 US recently, or 132 yesterday, I think it was $45 6 months ago. So if you put $100,000 into NVIDIA at 45 and it's now 130, which is a triple approximately, take out a third, get your capital back,
Yeah.
park your money, and then all you've got at risk is the gain. That kind of
Hmm.
thing. So these are some of the ideas. The other is I think it's time for the fundamental indexes to perform, and that's one of our two main strategies. I think we're done.
Yeah. Thanks for tuning in to Tower Talk. We appreciate it. If you want us to talk about anything specific, send us an email. If you have any questions about your own portfolio with Tower or at a different asset manager, please let us know. We'd be happy to chat.